Hello, hello. Welcome to an educational webinar on the Bank of Japan, Japan's economic problem and Bank of Japan's actions. This webinar is to go more into depth on the Bank of Japan and how they have developed their monetary policy since the 1980s up until now. We're going to look at few types of monetary policy that they have developed upon and the tools they use to actively try to get Japan out of their de-inflation process. So this webinar is mainly to a lot of the times focus can go on the major central banks of the world. Of course, Bank of Japan is one of them, but majority of the markets tend to put a lot of emphasis on the Federal Reserve, but Bank of Japan is also very important. All right. So before we jump in, this is more of a webinar on the history of Japan's economic problems and how the Bank of Japan has dealt with it. Before we get started, this webinar is presented by Capital Hungry Market Research Group, and let's jump into it. So Japan's disinflation problem. So in the 1980s to 1990s, Japan faced a prolonged economic challenge since the early 1990s, marked by persistent low inflation or deflation, where prices remained stagnant or declined instead of showing typical inflationary trends seen in robust economies. And this issue originated from the burst of an asset price bubble in the late 1980s, when Japan had witnessed a speculative surge in real estate and stock markets, resulting in inflated asset prices. And eventually, this led to a bubble burst in the early 1990s, which led to a further more severe economic downturn and prolonged period of economic stagnation. And these are all words that we have heard over and over in the US economy, but it's also, we can see instance of an inflated bubble. And once a bubble bursts, we see severe economic downturn. So these were some of the causes of the disinflation problem that Japan experienced in the 1990s. First was weakened consumer and business sentiment after the burst of that bubble, which led to weakened demand. Japan is a little different because they have a rapid aging population, right? So they have way more older generation people than younger working class. And the aging population tends to spend less and save more. So they're contributing less towards the economy and just more so keeping money in their banks. When this economic downturn happened, Japan also had a banking sector collapse fear. And Bank of Japan's initial actions were very limited in deploying an effective monetary policy to combat such a downturn, which further led to the disinflation problem. And increasing expectations of disinflation also led to further disinflation, as we've talked about the importance of inflation expectations and how they need to remain anchored. You may remember hearing several times throughout the past 2 years where the Fed has talked about inflation expectations being anchored. So in the late 1990s, this is when the introduction of ZIRP and plus QE was shown. So ZIRP stands for the Zero Interest Rate Policy, which was first introduced by the Bank of Japan in February 1999. This policy aimed to combat the inflation and stimulate the economy by reducing interest rates to virtually zero. Later in 2001, interest rates were brought to 0.1% and QE was introduced, which is quantitative easing. So ZIRP marked a significant step in the Bank of Japan's efforts to address the prolonged period of economic stagnation and deflationary pressures that followed the burst of the asset price bubble in the early 1990s. Right? So zero interest rates, they make it easier to borrow. They make it less costly to borrow. So key aspects of the policy were Bank of Japan reduced short-term interest rate to near 0% to make borrowing costs extremely low. Engaged in QE by purchasing large volumes of Japanese government bonds and other financial assets. Aimed to boost consumer spending and investments, an overall goal to fight disinflation trend. So over time, the Bank of Japan adapted the ZIRP policy and introduced variations like negative interest rates and yield curve control to address economic challenges and achieve its inflation goals. And this is where Kuroda era starts. The GOAT. Haruhiko Kuroda became the 31st Bank of Japan governor on March 20th, 2013, and he had a long reign in the Bank of Japan. So throughout his time in this role, Kuroda prioritized substantial monetary easing efforts to address the pressing issue of deflation, which has been a primary focus for Bank of Japan since the late 1990s. Right? Earlier signs for deflation were seen in early 1990s, mid 1980s, but steps weren't taken until well into 1990s. And he's widely recognized as a pivotal figure shaping the direction of the Bank of Japan's monetary policies. Okay, so key aspects of his policy, he's introduced quantitative and qualitative monetary easing, which they called QQE in 2013. This program focused on doubling the monetary base and substantial buying of Japanese government bonds. He also introduced yield curve control in 2016, targeting a steady yield on 10-year Japanese government bonds for stable, low long-term interest rates, and continuously emphasized the significance of inflation expectations and achieving the inflation target. Again, he's very putting a lot of emphasis on inflation expectations. Kuroda's view on inflation. So at the start of Kuroda's governmentship in 2013, the inflationary pressures were gathering pace in Japan, but to some extent in other industrial economies as well. But Kuroda's term ended with inflation above the 2% target, which was a significant goal for him, right? But he admitted later on that it's unlikely to be sustainable. So from the fiscal year of 1998 to fiscal year of 2012, Japan experienced 4.1% decline in consumer prices over 15 years, which averaged only 0.3%. And you may be thinking, like, this isn't that much, right? It's not a lot. It's only 4.1% over 15 years. Like, you might be thinking that, oh, we thought that this problem was much larger, because we know that this Bank of Japan has had a very loose, ultra loose monetary policy for the past few decades, right? But keep in mind, while the inflation was less severe than commonly assumed, it persisted for 15 years. And Kuroda compared the situation to chronic illness, which, while causing little immediate discomfort, can stealthily damage the entire body over time. All right, so that is a great comparison. That it may not be in the first few years where you see the effects of the inflation, but over time it's going to compound, right? So mild and lasting deflation in Japan discouraged spending by households and businesses. Consumers continued to wait for lower prices because they assumed prices were going to be lower. Expectations were prices were going to be lower, and the trend of prices was trending lower, right? While companies rather saved and invest, hindering growth and innovation. So this problem continued for decades, right? And over time, it just kept on compounding. People are spending less. People are waiting for lower prices and waiting. Companies weren't spending money in research and development. They were rather just keeping it in their bank, right? There was no growth, no innovation. I mean, it's labor demand, wages weren't growing, right? So, and we come to now, current monetary policy. So Kuroda resigned earlier this year, and that's when Ueda stepped in as the new governor of the Bank of Japan. So current policy objectives: the Bank of Japan has employed diverse monetary measures to tackle economic issues, such as its unlimited bond buying program under the quantitative and qualitative monetary easing strategy, right? So this initiative basically entails substantial purchases of government bonds, which we know is a continuation of what Kuroda did, and primarily Japanese government bonds, without a set ceiling on the total purchase volume. So this objective is to inject liquidity into the financial system while maintaining low borrowing expenses and spur economic growth at the same time. And the idea behind the unlimited bond buying program with yield curve control and other QQE measures is to combat deflation, stimulate economic growth, and push inflation toward the central bank target of 2%, right? And the Bank of Japan aims to boost inflation expectations, encourage lending, and support economic activity by keeping borrowing costs low. Emphasis on boost inflation expectations. So key components of this current policy are unlimited bond buying program, which we just talked about, right? Buying government bonds from financial institutions. That's what the Bank of Japan will do, and will in turn inject liquidity into the economy. And by purchasing these bonds, the central banks increase money supply and aim to keep long-term rates lower. Yield curve control, right? So what we just talked about, it involves setting a target yield for, in this case, the Bank of Japan does it for the 10-year Japanese government bond, and effectively controlling the yield curve to keep interest rates at a desired level. And negative interest rates, this was introduced into the Bank of Japan's monetary policy. So where they start charging commercial banks for excess reserves they deposit at the central bank. So this is another attempt to encourage banks to lend money instead of holding excess reserves. And for now, let's have this focus on YCC, or yield curve control, which is a monetary policy tool used by central banks to influence rate across various maturities on their yield curve. And the Bank of Japan uses yield curve control to target a specific yield, which is 10-year Japanese government bonds, as a way to control long-term interest rates and support its monetary policy objectives, right? So how do they do this? Is via market operations. So if the yield on the 10-year Japanese government bond starts to rise above the target rate, which was previously capped at 0.5%, or now capped at, not really capped, we'll get into that more so at 1%, the Bank of Japan intervenes by purchasing bonds to decrease demand, right? And increase demand. And this increased demand for bonds puts downward pressure on yields, helping to keep them around the desired level. And we'll look at some charts surrounding this scenario. And with the unlimited bond buying, the Bank of Japan doesn't have a specific limit on the amount of bonds it will purchase to achieve the yield target, right? So the purpose of capping the 10-year Japanese government bond specific level is, again, to keep interest long-term borrowing costs low and stable, so keeping long-term interest rates low. And this is intended to support borrowing, investment, and economic activity by providing businesses and individuals with certainty about future borrowing costs. So previously here we can see Bank of Japan had a yield curve cap of 0.25% on the 10-year Japanese government bond yield, where every time we approach 0.25%, we saw the yields drop because the Bank of Japan would buy, right? We'd exceed it, and then Bank of Japan would buy. They had an unlimited bond buying program where this is basically like a limit order, right? This is a forced limit order, which is artificially setting the price of the 10-year Japanese government bond, right? And this can cause all sorts of distortions, as this is an artificially set price. It's not the real market price, which government bonds yields are market set prices, right? So earlier, Bank of Japan raised the yield curve control cap to 0.5%. And when they did that, instantly, the Japanese government bond 10-year yield shot up to near 0.5%, which is where Bank of Japan started buying bonds again. Unlimited bond buying program, in effect, unlimited bond buying program, buying bonds, right? So you can see Bank of Japan bond buying at 0.5% cap. Just going to get some water real quick. The recent Bank of Japan developments. Bank of Japan refined the cap on the 10-year Japanese government bonds to a flexible upper 1% upper bound rather than a rigid cap, mentioning that it is a reference point, right, rather than a fixed number. So they'll conduct large bond buying operations to prevent the 10-year Japanese government bond yield from moving sharply above that level. And further, on October 17th, the yen spiked due to Bank of Japan expecting their inflation forecast to be higher for fiscal year of 2023 and 2024, while inflation forecast for 2025 is expected to be 1.6%, which is dropping below the 2% target, right? And that's not the best thing. That's not what the Bank of Japan wants to see. And again, that goes back to Kuroda's comments where he said that this increase in inflation is not going to be sustained because a lot of it is supply side. So this is just a headline from October 17th, Bank of Japan's year-on-year rate core CPI forecast for fiscal year 2023, fiscal year 2024, highly likely to be revised upwards. So this is Bank of Japan forecast shows CPI will have a hard time sustaining above 2% in the long term. And here we can see core CPI. This is the October view. We'll look at the July view first on the right-hand side, where we see for 2023 to be 2.5%, 2024, 1.9%, and 2025, 1.6%. And then in October, the revised higher, so 2.6%, 2.8% for 2023, 2.8% for 2024, and 1.7% for 2025. Still below 2%, right? So it's hard time sustaining above 2%. So going back to this, with most recently, now we've had Bank of Japan raise their yield curve control cap to 1% and saying that it is not a rigid cap, basically meaning that there is no real yield curve control cap since they're not capping it. It is more so as if Japanese government bond 10-year yield reaches those levels, the Bank of Japan will conduct massive bond buying operations. But technically, they don't have a cap. It is just, like 0.5 was a clear cap. Same with 0.25 was a clear cap, right? Just something to consider. And every time here, Bank of Japan was still conducting bond buying operations when we were pushing up towards 1%. In order to keep these bond yields from surging, right? And a lot of this is because they're artificially maintaining the yield on this. So as soon as they took that cap off, markets naturally started to increase the value of the yield, 10-year Japanese government bond yield, right? But Bank of Japan was conducting bond buying operations. And you can link headlines to these points where they conducted bond buying operations. Of course, this was a major one. So this is very interesting, is you can also see that the US 10-year yield pushes higher after Bank of Japan sets the 1% yield curve cap. That's why I have sets in quotes, because they didn't really set it. It is more so a loosely defined set or a loosely defined yield curve cap. So we can see that unconsequentially, remember how Powell and the Fed have all been saying that the 10-year yields, the long-term yields are doing some of the tightening work for them, right? And this was a big market event that helped push 10-year yields higher. So technically, it technically could be said that the Bank of Japan is helping tightening for the Fed. And this is one of the reasons that the term premium and the US 10-year yield has gone higher, was after the Bank of Japan sets the 1-year yield cap instead of the 0.5 year. They remove the 0.5 and they make it 1 year. And you can go back and see this was the exact day the 10-year yield also started going up. So current situation. And here's some headlines. Bank of Japan Governor Ueda we will consider ending yield curve control negative rate if we can expect inflation to sustainably hit price target. Key to consumption outlook is whether wages will continue to rise. So the Bank of Japan hopes that inflation will pick up again in the future based on the cycle driven by higher wage growth, employment growth, sustainable corporate profit increase, positive output gap, strong and sustainable underlying inflation, and higher long-term inflation expectations, right? We can see that, yeah, Bank of Japan inflation expectation went up by like 0.1% for 2025, but it's still below 2% for 2025, and that's core inflation, right? So for inflation to sustain above 2%, more of it has to be driven by higher domestic demand, corporate profits, and wage growth. So far, it has largely been driven by supply side factors. So keep that in mind. That's a big important part to think about when thinking about when the Bank of Japan will unwind its ultra loose monetary policy, is when we will have to see periods of inflation driven by higher domestic demand, corporate profits, and wage growth mainly. So this is Japan year-over-year consumer price index, and we can see that it was near the end of Kuroda's term in Bank of Japan as the Bank of Japan governor, where they achieved the 2% target for inflation, right? But this was mainly driven by supply side factors, and he even knew it wasn't going to persist. And we can see it's come down since then to 3%. So again, we'll see how it continues to progress, but there are always risks of prematurely tightening in this case. So this is Japan's year-over-year wage growth, where we can see that in order to achieve 2% inflation long-term wage growth also has to be pointing toward the 3% sustainability year-over-year target. In this case, we do not have that either. So the current situation has yet to reach a point where the 2% price stability target is attained consistently and reliably, among with growth in domestic demand and wages. Given the considerable uncertainty about Japan's economic prospects, the central bank must concentrate on sustaining growth through extremely accommodative policies until wages show more substantial increases. Prematurely tightening policy could further dampen inflation expectations, significantly increasing the likelihood of initiating a disinflationary trend. And that's what I'm talking about, it could further dampen inflation expectations, which is a very, very important thing in forecasting inflationary trends. And interventions, everybody's favorite topic, apparently. So conducting interventions, Bank of Japan's ultra loose monetary policy has continued to put pressure on the yen, creating instances for the Ministry of Finance to intervene by selling US dollar liquid assets in exchange for purchasing the yen. And they do this, so the Bank of Japan does this on behalf of them, but the Ministry of Finance has to conduct these. And these are limited in nature as they are resource costly, right? In the medium term, this approach isn't viable because we can see algorithms, because of the rate differential between Bank of Japan and the Federal Reserve, algos will continue to buy the US dollar or start buying USD and they'll start selling the yen, right? So a lot of the times these interventions are not long lasting, and they first intervene by almost like a surprise shot. So consequently, for both the Ministry of Finance and Bank of Japan were fortunate when they intervened last October in 2022, because there was a shift in global economic trends happening, right? So following the October 2022 interventions, it led to a turnaround. And this reversal prompted the US dollar to retreat from its prior gains due to the following factors. The Federal Reserve was coming off of the front-loading cycle around October 2022. Dollar and 10-year yields were peaking at highs. In the next FOMC meetings, Fed went from 75 basis points to 50 basis point rate hikes. Inflation also started showing increases happening. Remember when, this meant to say inflation started showing decreases. Remember when last year inflation started showing decreases for October, November, December, and then the Bureau of Labor Statistics in January 2023 came out and said, oh, actually inflation increased, right? So there was a variety of factors that helped Bank of Japan and Ministry of Finance create that top on dollar and that bottom on the Japanese currency index, right? So the September intervention was more of a warning shot that happened. And then in the October intervention was a much more strategic intervention where it was very well coordinated with other financial markets. And we saw dollar also reverse, yen gain strength, and a bunch of those factors that we previously listed helped play that more in effect. We come back to the October 2023 intervention, where we saw a slight push reacting at 150, where market UJ dropped to 147-ish. And then we've seen price push back up near 150, just below it, but we've seen natural profit taking at 152. And recently, I caught the top on this at 151.91. So yen futures and currency indexes also are rebounding from lows here. We can see we broke below lows from last year, just momentarily before we saw natural profit taking happening here for sellers and buyers jumping in. So for the base case scenario for Ministry of Finance, recently the Ministry of Finance did not intervene at 152. Best case for Ministry of Finance. And recently the Ministry of Finance did not intervene at 152 on UJ, as market participants did the work for them with the help of the following. And this is something that was mentioned in Capital Hungry as well when I was creating the CPI prep webinar, where we talked about CPI being a big focus, and they weren't going to intervene before that because CPI was expected to decrease by 0.5%, right? So first of all, natural profit taking occurred at the 152 price level on USD JPY. Okay. Second, US CPI was showing a 0.5% decrease in the year-over-year reading, leading to dollar weakness and markets pricing in cuts as early as next year, May next year. And continuous bad US data, so PMI, labor market data, durable goods, retail sales, just to name some. These were all factors that were going to lead to the decline and weakness in the US dollar after it had like a 13-week run. We've seen consolidations over the past few weeks, and all these impacted, led to dollar weakness, which would also, as a matter of fact, bring USD JPY to lower levels and would not push it above 152, right? So this was the best case. The best case scenario for Ministry of Finance to not intervene would be that dollar continues to weaken on a dovish Fed and weakness in US data through the deterioration of the US economy with policy lag effects next year. And that would be the best case scenario, right? We're not ruling out any interventions because interventions can still happen. We can still see yen futures and yen currency index return to lows and keep continuing digging as the Bank of Japan maintains its ultra loose monetary policy, right? And we'll also have to watch dollar and see if it surges with volatility. But we can see they don't necessarily have to intervene at 152. They can, but 153, 155, 158 plus, these are also solid levels that we can potentially return to. 153 being more the focus. Right now, it being 152 to 153. But we can see UJ's around right now at 148.7, right? So we can see soft dollar is definitely helping out, and it can continue to not, for them to not intervene as long as dollar remains soft, right? And UJ remains below those price points. Thanks everybody for watching. This was just a good educational webinar highlighting the Bank of Japan, Japan's history, and actions taken by the Bank of Japan to combat Japan's everlasting deflation problem. Hope you enjoyed it. Let me know what you think in banter. And this is a much bigger topic that if you're interested in, do your own research. I couldn't comprise everything in this without it being a 2 hour long webinar. And a lot of you have low attention span. So yeah, I hope this was good enough. All right, guys, take care.